Hey, hello, everyone. Welcome to Finance Friday on the ARCUK YouTube network. This is Hard Money Jim speaking to you from sunny Coronado, California, where they like to say Main Street meets bare feet on the local beaches. Now, today, we're going to talk about gold as an instrument for some of your savings. Placing some of your savings into gold is a practice I believe everybody can benefit from, although most people ignore it. So here, I'm going to show you, is a common coin called let's get back in the screen here, called a buffalo. It's called a buffalo because it's got an American buffalo on one side and a Native American profile on the other. It's actually quite attractive. Now, this one's not a rare coin, but it's one that has probably changed hands many times. It trades at a price a little above its bullion value of today about $1,840 per ounce, plus a 3 to 7% coin premium, depending on the condition of the coin and the dealer you use. This is 1 ounce, this coin. Now, that price translates, that $1,840 per ounce price translates to about $65 per gram, a gram being approximately equal to the weight of a cubic centimeter of water. There's 1,000 grams in a kilogram. When you're quoting prices for large amounts of gold, dealers and pricing agencies usually use metric tons, which is 1,000 kilograms or 2,204.6 pounds, not the 2,000 pounds in an English ton. Now, if you're slightly confused by all those conversion numbers, good, because I want you to be careful when you buy gold to know what you are buying and compare what you buy to some standard price. I track the price of gold in dollars per ounce. It's a commonly used, readily available, and fair quote, and I'm careful to translate units of everything I buy back into that standard. Now, you can own gold in this form, coin form, or in rare coins that trade at a substantial premium to their metal value because of their rarity, or in bullion form, that is in bars of fine gold or various sizes and weights. And you can even own gold in this form, rather new form. This is a bill. Like this one, it's a polymer sheet impregnated with a specific amount of pure gold. It fits into your wallet nicely. These kinds of bills are considered legal tender in some states in the US, although they're not used widely in daily commerce. I occasionally leave them as bar tips, and people remember it. Okay, so let's share the screen here and talk about gold. If I could get us moving here, here we go. Okay, now I use the pseudonym, that's a blow up of the coin I just showed you. I use the pseudonym Hard Money Jim for my Substack letters and podcasts, so you're not surprised to hear that I think everyone should own gold, have some. And today, I want to share with you why I think this is so. And by the way, I'm talking about only gold today. Many of today's observations that we make could also apply in some ways to silver and other precious metals like platinum and palladium. Gold is my precious metal of choice because it's the purest monetary metal, whereas the others have industrial value as well, which tends to complicate their valuation, in my view. Now, I know that many people are skeptical about owning gold and hoarding gold in physical commodities like gold, including some famous investors like Warren Buffett. Here's a USA Today story from a few years ago. And Warren Buffett said, this was at Harvard in 1998, he said, gold gets dug out of the ground in Africa or someplace. Then we melt it down, dig another hole, bury it again, and pay people to stand around guarding it. It has no utility. anyone watching from Mars would be scratching his head. So Warren Buffett apparently disdains gold, saying it's an unproductive rock, sort of echoing John Maynard Keynes, who called gold a barbarous relic. But there's just one problem with this attitude. Does Buffett also disdain money? Does he think a dollar bill has, quote, no utility? The fact is, gold is money, and it's been recognized as money, both popularly and legally, for thousands of years. And all money has utility in exchange for other goods and services. And the exchange value of gold, and all money for that matter, is powered mostly by voluntary choices in the market, not by some investor's idea of, quote, utility. So it's interesting that Buffett chose to ignore those well-known facts in his 1998 remarks. And I think his remarks were especially interesting and ironic, given that his father, Howard Buffett, who was a stockbroker and served 4 terms as a U.S. congressman from Nebraska, was by today's standards a true gold bug. And I mean that as a compliment. Howard Buffett was a consistent advocate of sound money, limited government, and responsible spending. All of that regulated by a gold standard. The article referenced in this slide, the one on top there, is available on the internet, and I recommend you look it up and read it. It's a smart, plain language advocacy of gold that everyone can understand. And of course, here's a good excerpt from one of Howard's speeches before Congress. I warn you that politicians of both parties will oppose the restoration of gold, although they may outwardly seemingly favor it. Unless you are willing to surrender your children and your country to galloping inflation, war, and slavery, then this cause demands your support. For if human liberty is to survive in America, we must win a battle to restore honest money. There is no more important challenge facing us than this issue, the restoration of your freedom to secure gold in exchange for the fruits of your labor. Pretty strong stuff. So Warren Buffett's 1998 Harvard comments puzzled me when I saw them, because Warren Buffett is a brilliant man, and it's not possible that he's ignorant of the role of gold as money, especially given his father's reputation as a sound money advocate. And Buffett added to this puzzle in 2020 when he bought a big stake in a very large Toronto-based gold mining operation known as Barrick Resources. He had to disclose this purchase because of its very large size, publicly disclose it. Apparently, Warren hated gold until he loved it. But why did he change his mind about gold? Maybe it was because he noticed that the price of gold had outperformed the stock price of his own company, Berkshire Hathaway, up to that point of the 20th century. Now, to be fair and accurate, since Buffett made that purchase, Berkshire Hathaway stock itself has outperformed gold, and it's also outperformed Barrick Resources stock. Both Barrick and gold have been fairly flat since then. The point, as we shall see, is that gold can perform quite well either by itself or in a portfolio. Let's see. I'm just looking at the chat here. I'm doing something new today. I'm able to monitor the chat on a separate monitor, and I see you guys talking to each other, and that's great. I'll try to monitor your comments or questions to me as well. Okay, now I said in the last podcast that I think gold is the asset of choice under financial repression. And there are other assets that can work well, but gold's perhaps the most neglected, meaning it's the least well known by those who are the biggest victims of financial repression. The biggest victims being ambitious, middle-class, aspiring earners and savers. Most people think of, houses and stocks as the major buffers to inflation. Very wealthy people understand that these are not the only inflation buffers. Inflation harms everyone, but wealthy people are often able to take relative advantage inflation by placing, some of their wealth in gold. But what about the average saver or young people trying to start in a savings program under, this financial repression? Shouldn't they put some savings into gold? My purpose today is to alert the average saver to the benefits of gold as a vehicle for savings for you and for your family. Because of its unique characteristics, anyone with savings can put some of their savings into gold. And so today I want to address some basic questions about gold as an asset, as a savings asset. I want to stay practical today, avoid the deep monetary theory, as interesting as that is. So here are some of the questions before the house today. Why should you own gold? And that's really the biggest question. When should you acquire it? Now, anytime? In what form should you own it? Bullion, coins, gold mining stocks? How much should you own? Who should you buy it from? When should you sell it? That is, exchange it for fiat currency. Now, let me pause here for a footnote. As we go along today, I want to pause at appropriate times to address some questions that I got from a subscriber named Tom, because I found that in preparing this material, some answers to his questions came to mind that I'd like to share. And also, I must add that what I say is not investment advice. I hope what we say today is entertaining and interesting, but you should do your own research or consult your own investment advisor before making any investment decisions. Also, and I think many of you are aware of this, but let me remind you that I sit on the board of a company called Monetary Metals and Company, which is involved in gold investing. So my words today are not a solicitation for engagement with that company or in any company. Anything I say today, I would have said even if I had no affiliation with a gold-based company. So with that out of the way, let's jump back in and ask, why own gold? In my view, gold is close to an ideal long-term investment, which does not mean it's your only investment, but an investment that checks several important boxes. And what are the characteristics of a long-term investment? 3 features or qualities are most important in my view. An ideal investment is scarce, permanent, and independent. Now, these criteria are not my invention. Thanks to an investor named Anthony Deaton for identifying them. You can look up Tony Deaton, by the way, on the web. I recommend you go and read his wisdom, which is free and it's well worth it, whether you're a seasoned professional investor or a novice. But let's focus on these 3 characteristics, and I'll say a few words about each one. First, scarcity. True scarcity obviously means unusual and an unlimited supply. Now, this is a hard attribute to find, especially in a money-making business. For example, you might invest in a business like a restaurant or a dry cleaner and be successful in it because you're the best among your peers. But these services are generally not scarce. Gold, however, possesses true scarcity. It's naturally beautiful, attractive to hold. It's hard to mine, requiring the expenditure of real resources to get it out of the ground. The total stock of gold only grows at most by 1 or 2% a year. Over the millennia, gold production has grown roughly in proportion with the growth of the world population. So price inflation in terms of gold, when it happens, is limited. There actually isn't much gold in existence. You could comfortably stack up all the gold in the world on a baseball diamond or a football pitch. Now, despite this scarcity, it's highly divisible and malleable, making it easy to hold, transport, and divide. And these and the other ideal money characteristics are what make gold as money so rare and so scarce. Second, permanence. Gold does not oxidize, does not corrode, it does not dissolve. Pure gold does not tarnish. It's among the most durable of all metals. It's nearly impossible to destroy. except for losses as when a ship sinks. Virtually all the gold ever mined for thousands of years is still in existence today. Gold is as permanent as any money can be, which means you can expect it to have value long after you're gone, or long after any particular entity that issues fiat money has evaporated into history. This permanent character is a major reason gold has held value in the past and will hold value in the future. You can't say the same thing about promises to pay or about fiat currencies. Okay, third, independence. Another reason gold has endured over thousands of years and survived hundreds of failed governments is that it represents full and final payment. Gold is the only true money in this sense. It depends on no other counterparty to give it value because it's universally valued by individuals in the market all over the world. In other words, its value is dispersed. Gold requires no banks to make a payment. It is payment, in contrast to a bank deposit, which is a duty or a promise to pay. In testifying before Congress in 1912, J.P. Morgan famously said, "Gold is money. Everything else is credit." When other forms of payment, like bank credit, fail, it's still pretty easy to move gold across borders in briefcases and private jets. And when gold changes hands, the transaction is complete because you're not holding someone's promise to pay. While money can be completely immune to, while I should say no money can be completely immune to, government coercion, gold is at least independent from the government-regulated financial system. So it keeps some distance from government meddling. Gold is the standard money chosen by the market, by the people, and not by the government. So scarcity, permanence, and independence. As far as I know, there are practically no securities, meaning stocks or bonds or other paper promises that meet these criteria perfectly, because all securities are based on business prospects, the rule of law, and somebody's promise. I don't know of any business you can buy that meets these criteria perfectly, although I'm still looking, but gold scores pretty high in my book. When gold is viewed this way, it's surprising to me that a brilliant value investor like Warren Buffett would make the silly remarks that he did. Now, I won't speculate any further on his reasons for that, but I do think Buffett's, anti-gold comments are typical of the error and the bias against gold. Gold's been recognized as money for thousands of years. It's the only money, with the possible exception of silver, that's been universally and voluntarily chosen by the market, that is, by the masses of people, as standard or reserve money. By standard money, I mean a medium of exchange, which, as I said, constitutes full and final payment, discharging all other promises to pay. Today, fiat dollar bills, the paper bills that we carry, are also full and final payment. They're legal tender, meaning they discharge all further credit and debts on payment. However, the well-known problem with dollar bills is that the US government produces them by the hundreds of billions at no cost. And the result is inflation, which is the major consequence of fiat money creation. One reason to own gold is the same reason you keep a cash reserve in your pocket or in your safe or under your mattress. You're quite rationally hoarding some cash for the proverbial rainy day. If you're going to hoard some money, why not hoard something that will retain its exchange value over a long period of time? And gold does exactly that. Okay, another reason to hold some gold is that it's a good diversifier of price risk because its exchange value is not well correlated with other assets. In other words, its price in dollars zigs when the price of other investments zag. And here's a good example. This chart compares the long-term price in dollars of gold, that's yellow, the Dow Jones Industrial Average, blue, the Standard & Poor's 500, red, and silver, which is in the gray or silver color there toward the bottom. The stock performance, by the way, I should say, does not include dividends. If you include dividends, it outperforms gold by a lot. But it does not include dividends, which I think is appropriate because gold in your pocket also cannot earn a safe return. It doesn't earn interest if it's sitting in your pocket. I chose what I thought was an appropriate starting point for this series, August 1971, when the USA severed its last ties to gold as money. So over this long period, gold priced in dollars has performed very similarly to stocks. But notice that its price does not closely correlate to stocks. It often zigs. When stocks go one way, gold often goes another. For example, from 1971 to 1996, if you look on there, a mostly inflationary period, gold outperformed stocks. From 1977 up to the financial crash, stocks outperformed. For a few years after the crash, gold vastly outperformed. And then more recently, stocks have outperformed. So, during that period of the crash, I guess you could say gold got ahead of itself for a while, but this is just the way it performs, non-correlated to other asset classes. But now let's look at the recent past, the last 15 years, just to make the point. Post-financial crash, stocks have vastly outperformed gold, as I just mentioned. In fact, passive stock performance has outperformed almost anything else you could do. Now, I suspect this recent outperformance is biasing the decisions of many investors today who think that stocks are always destined to outperform just because that's what's happened in their own personal investing career. We talked about that a lot last podcast. Now, if that's what you're thinking, you might be right. But I do think it would benefit you to look at the longer term record and ask yourself why you think what has happened in the last 15 years should continue for the next 15 years or more. Now, you know that I have advocated gold as a way to save under inflation, but please beware, if your definition of inflation is an increase in the consumer price index, you might be disappointed in gold. The gold price does not go up or down in perfect correlation with the CPI. Gold can't read the CPI, which is a pretty arbitrary measure of price increases. There are a myriad of factors, not the least of which is that the gold market might be anticipating all of the manifestations of inflation, not just the timing of the increase in consumer prices. Also, gold competes with other investments for investors' money. If investors decide to sell stocks to put even a small portion of that into a gold position, that could affect the gold price significantly. Now, I personally do not try to anticipate the gold price in dollars over any short or intermediate period of time. Instead, I try to judge other assets in terms of gold. I have occasionally traded gold for other assets I thought were valuable, but I've never sold gold for cash because I thought its price was, quote, too high. To me, gold is a permanent or near permanent savings vehicle. So I can imagine a condition under which I'd sell some gold to buy something else valuable, but that would be a rare case. Now, here is what I mean, an example of what I mean when I say gold holds its value versus other assets over a long period of time. This chart, which I found in an excellent essay by Alistair MacLeod from the Cobden Center, shows the price of a house in London, typical price from 1968 to the present. The blue line is the average price in pounds, British pounds. The yellow line, the very flat, steady line, is the average house priced in units of gold. This chart actually supports my argument from last time that you should own a home as a way to preserve savings over the long term. And over this period, the fiat money price of a house in London went way up over 120 times, preserving to a great extent the purchasing power of the Great Britain, the pounds of the pound, I should say, if you eventually traded your house for fiat currency. Now that's great, but in fact, it wasn't much more than a pretty good preservation of real value. It wasn't a huge real return on investment. Despite the big numbers, the house priced in an inflation-resistant asset, that is gold, it was as steady and as flat as a pancake, as you see on the bottom there. In units of gold, the average house price went up only 29%. Now, to be clear what this means, in 1968, you could have bought gold instead of a house, and if you then exchanged it today for fiat, you would have increased your fiat money almost as much as you did by owning the house, right? So, of course, the two assets are not perfectly comparable. You got to live in the house, but you also had the expense of maintaining it. On the other hand, it wasn't a liquid asset. You didn't have to do anything with the gold, but remember where you put it. There was no risk of storm damage, for example. So, there are trade-offs for sure, and they're not really comparable assets, but both hold their value quite well, is what I would say. All right, so let me pause here. Okay, there's a question here about gold, my thoughts on the long-term total return of the S&P 500 versus gold. Is gold a good investment or should it be considered a hedge? I'm going to answer that briefly. I think over the very long term, the S&P 500 will likely outperform gold. There are risks to indicate that it may underperform for very long periods, as I indicated last podcast. Is gold a good investment or should it be considered a hedge? It is both. It's a diversifier if that's what you mean by a hedge. That's what I take to mean a hedge. And we're going to talk a little more about diversification in this talk. And Jerry asks, the gold price seems to be largely driven by the derivatives market. Some observers say there's a distortion on those markets. Thus, the price of gold does not reflect its true price. Is that right? I think I disagree with that, Jerry. There's been questions about does the futures market, which is what I think you mean by derivatives, does the futures market, is it manipulated to change the price of gold? We have had some specific cases in some of by sort of rogue bankers doing this, manipulating the price of gold. That's been, at the market. It's not like they can manipulate the price of gold from, say, 1850 to 1650 overnight. No, I don't think that happens. I think you can look generally at the futures market and the spot market. You see differences. Sometimes it's contango, sometimes it's, whatever. I think you can usually explain that by supply and demand. So no, I generally would disagree that the gold price is manipulated by some derivatives market. The gold is too widespread and too widely traded to do that. It's traded all over the world. I grant you short term, there may be some manipulation going on that would not otherwise occur by big players. But I think I would kind of agree that the gold price is the quote true price. The price is the price. Okay. Now here's another example. Let me get it going on here. Here's another example of gold's purchasing power. This is from an investor named James Turk, who's very knowledgeable about gold. And by the way, Turk is worth looking up, and he's very worth reading. This chart shows the price of oil in British pounds, that's blue, US dollars, that's orange, euros, that's gray, and gold, yellow. Notice once again the price of gold, price of oil in gold, this is oil priced in gold, is quite flat and fairly predictable. Within a reasonable range, it's actually almost too small to show on this chart. A barrel of oil today trades for the same quantity of gold, approximately, that it traded for 60 or 70 years ago, roughly a gram of gold. And it doesn't fluctuate much in terms of gold money. In other words, gold held its value quite well compared to houses or oil. And this is true of virtually all other commodities that I am aware of. Now, this would be a good time to pause and address a question from Tom that he posed to me after our last podcast. Tom asked me, what happens when the value of your house becomes a very large portion of your net worth? Isn't it too risky, he asked, to have so much wealth tied up in a house whose value is tied to a particular location, a particular market, and all those unique risks? Well, I think, yes, depending on individual circumstances, that could be a valid concern. Owning some gold actually addresses Tom's concern. If you put some of your real estate wealth into gold, you're going to likely maintain the value of that wealth while avoiding the market risks and the business risks of real estate and stocks. But you also have more liquidity. You can monetize all or part of your gold at any time. You can't do that with an expensive house. Your choice is generally to hold or sell that house. You can't just sell part of it, in other words, unless you want to borrow against it, which is sort of defeats the purpose. So, Tom, I would say owning gold can actually help address your concern about diversification away from your personal real estate without buying more stocks or bonds. I bring it up because relatively few investors today think about gold as a portfolio diversifier. They mostly think of diversification, some person on the chat here called it hedging, as a trade-off between traditional markets like stocks and bonds and real estate and cash. Gold is considered an exotic asset by many, but it's actually one of the oldest investments in existence. So I recommend you add gold to your list of possible investments and savings assets. Keep it in mind. I want to pause here and recommend a book for anyone who's serious about the history of gold to learn how it provided a very stable currency over a very long period of time and how well gold adapted itself to the industrial age and an era of rapidly expanding trade and rapidly expanding technological progress. This is The Golden Constant by the late Roy Jastram, and it's a fascinating historical study of the price of gold over a 450-year period. Jastram's data is very meticulous, and it shows that gold provided remarkably stable prices over most of the developed world. The book's only available in hardcover, unfortunately. It's a little expensive, but it's worth having if you have this level of interest. Anyway, it's an interim summary. There are two good reasons to own gold at any time. Anytime. First, it holds its value over time. And second, it's a good risk diversifier versus stocks, bonds, and real estate and so on. Let me check here. Let's see. Other comments, thoughts, long term. Okay, looks like I'm caught up. I can't believe I'm getting up to I'm up to the 20th century, guys, not the 21st century. But at least I'm in the 20th, right? It's being able to monitor these chats, in real time. Okay, so now those are two good reasons to own gold, but I want to now add one more, little more controversial reason. And in other podcasts, I've already mentioned some of these more controversial reasons. If, as I believe, we are in a period of long-term financial repression, gold should hold its value well. Safe financial assets like treasury notes will likely earn a negative real rate of return, meaning their principal and interest will not keep up with price increases because repressive government policies designed to encourage inflation and suppress interest rates. Gold by itself pays no interest, but as we've seen, its price keeps up with inflation over time. When real interest rates are negative, in other words, they no longer compete with gold. So, but there's another related reason to this, which is that the dollar may be in the early stages of being replaced as the world currency. Now, I believe this is a very slow process, and it's not as if the dollar is going to be completely replaced in my lifetime or anything like that. I don't think that. But let me tick off just a few bullet points illustrating the movement by many national monetary authorities to start using some standard money other than the dollar to settle international trade. First, central banks around the world are buying gold in very large quantities. You've seen this for a number of years, and just in the last year, it's been noticed by the mainstream financial media, such as Financial Times and The Economist and Bloomberg News. And you have to think, why are they doing that? Central banks are doing this to diversify their reserves as protection against losses of purchasing power of the fiat-based sovereign securities that they're holding, which are mostly U.S. treasuries, convertible to dollars. The deterioration of the dollar is not just the result of inflation. In addition to inflation, the abuse of the dollar as a reserve currency, the abuse of it, is causing some countries to revolt against it. And let's now look at some of the indicators of this trend. Just tick some off here. The increasing use of U.S. financial sanctions, which consist of denying some governments access to U.S. banks and therefore access to dollars, has not worked. For example, financial sanctions did not bring the downfall of the heavily sanctioned governments of Cuba, North Korea, Iran, Venezuela, Russia. Those dictators are all still there. Sanctions have not worked. The latest round of sanctions, which was supposed to destroy the ruble and wreck the Russian economy, has failed. Russia has circumvented those sanctions pretty easily by negotiating bilateral trade deals with various countries that allow their trading partners to use rubles for trade. Russia uses its gold reserves as a way to settle trade imbalances. Russia has under these conditions, has to accept a discounted price for its oil, but at least they're not shut out of the market. And their trading partners, for example, China, like it because they get oil at a discount to the world price. The Gulf Cooperation Council, the GCC, which is a common market of Middle Eastern oil producers, is gradually turning its back on the dollar as payment for oil and gas. GCC is concerned that foreign reserves held in Western fiat currencies can be rendered valueless overnight, as with what happened with the Russian sanctions. I would also argue that climate change policies in the West send a message to the GCC that the future of their oil trade is not with the Western countries. There's also, the problem of inflation, which means that the surpluses stored in the form of sovereign Western bonds decline in value as the dollar declines, whereas their oil is increasing in price and in value. So for long-term growing or stable trade relationships, the Middle Eastern oil producers feel they must turn to Russia or the Chinese or the Indians and other emerging market nations. And that means trading, in some cases, in currencies other than the dollar. China has recently signed a 27-year supply agreement with Qatar for its gas. By contrast, President Biden attempted to secure an agreement with Saudi Arabia for additional oil, and he came up with nothing. He left with nothing but a fist bump. Trade between China and Russia is increasing. Russia runs a big trade surplus because of oil exports. China badly needs oil, and the surplus between the two is held in a gold differential account at the People's Bank of China, the Chinese central bank. Those surpluses were previously held in dollar-denominated investments, presumably U.S. treasuries. Now, the Chinese have opened the Shanghai Gold Exchange, where they sell their gold to their citizens. The exchange was established about 20 years ago, but since then they've sold 23,000 tons of gold just to the Chinese public. That's worth about $1.5 billion at today's prices, plus an unknown amount in international trade sales, which is not disclosed. According to the investor Simon Hunt, a few months ago, Saudi Arabia sold oil to China for Chinese yuan, for the RMB. Then they took the RMB and converted it to gold on the Shanghai Gold Exchange. So Saudi Arabia has sold oil to China for gold instead of dollars. The little nation of Ghana just announced that it will export gold in return for oil. Ghana is one of the largest gold mining countries. The vice president said recently, we're in the top 10 in the world, but we have not accumulated gold to build our reserves. So we ask the simple question, why don't we use that gold to pay for oil, sell the oil in cedis, that's the home currency, and then you don't need to look for the scarce foreign exchange to buy oil, which always leads to depreciation on the currency. So what you say, it's just Ghana? Well, I say yes, it's a small example, but the idea may spread. Then there's the prospect of an expanding war in Ukraine and possibly Taiwan. Wars are always funded by inflation, and political instability from the wars increases demand for gold. Now, all of these factors point in the direction of a gradual move away from the dollar to settle international trade, and gold is one obvious substitute for the dollar. All right, let's quickly review the fundamental reason that these countries might prefer dealing in gold as opposed to dollars. Practically everyone values gold, so it's a viable commodity money to use in exchange. In addition, unlike the dollar, gold doesn't know politics. Gold doesn't impose sanctions. Gold doesn't have any tanks or airplanes or central authority. Gold is simply accepted by billions of people worldwide as something valuable, and its characteristics are near perfect as a medium of exchange. So as soon as a government embraces it and says it will recognize gold as money, it almost certainly catches on in a big way. Using a fiat currency like the dollar as a tool, as a sanction tool, only works to a limited extent because eventually you're going to run out of economic power. Now, I want to offer a historical example that I've used before of why gold cannot be used for very long to coerce other nations. Gold cannot be used for some very good reasons. And here's an example. 180 years ago, during the Crimean War, from 1854 to 1856, Britain, France, and Russia fought horrible battles in what is now called the Ukraine. Hundreds of thousands of soldiers particularly, but civilians too, died on both sides. And yet throughout it all, the British Treasury kept paying its debts to the Russian government, and Russia kept paying interest to British citizens who owned Russian debt. It was unthinkable for these governments to renege on these obligations, even while their soldiers were slaughtering each other. Now, there were good reasons for this. In 1854, the international reserve currency was gold. If gold is the reserve currency and no single nation can issue the reserve currency, all nations basically have to bow to gold. Governments were dependent on the banks, and banks were dependent on their gold depositors, who were the individual owners of gold supplying the reserves. Failure of a foreign government, a sovereign government, to pay its debts would result in a run on the gold deposits in the banks, for fear that the bank would go bust. Remember, bank reserves in those days were controlled by the depositors of gold in banks, not by governments. Unlike today's money, gold, the reserve currency, was not created by banks, not created by a central bank, and it didn't even need a banking system to be recognized as money. Gold was then and still is independent of the banking system. The monetary authority was the market itself, not the government. Now, today, all fiat money and fiat currencies are the product of pure credit creation, which is increasingly controlled by sovereign governments. Governments authorize their banks to create money. Government, not the market, is the monetary authority. With government permission, a bank creates a ledger entry that is then used as money. That means the government can wipe out that ledger if it wants to for any political purpose. Money today is a made-up liability of a bank that exists because the government says it can. So it's easy for the government to tell the bank, nullify that liability, nullify that money, just cross it out. It's merely a ledger entry. Now, this is a key point. It is the current system of credit creation based on fiat reserve money that permits nations to weaponize their banking systems. Without government control over money creation and money transfer, this would be impossible. Under a gold standard with the economic power of the reserve currency dispersed among millions of depositors, that is, gold owners, it was nearly impossible for any government to renege on debts without severe consequences. It's no accident that the large, terribly destructive wars of the 20th century occurred only in an age of fiat money. The great wars of the 20th century would not even have been possible if gold had been in charge of war financing. Ironically, our enemies and even some friendly trading partners are starting to look toward gold once again. They're not looking at a gold standard, but it's just a nod in that direction. I don't want to overstate this case. But to sum up the point on why it might be compelling to buy some gold at this particular time, I think it's because as countries use their fiat currency privileges to deal with unpayable debts and try to impose their power on other countries, many trading partners, both enemies and friends, are going to distance themselves from the dollar in favor of an independent reserve currency. That is likely to be gold. And as this happens, the demand and therefore the value of gold will grow. All right. Now let me look to see what we have here. Bonnie made an interesting comment about heroic dads. I guess she's referring to Howard Buffett, who was a heroic dad. Yes, he was. And I know that story about Adam Reed's dad, too, which is very interesting. Thanks, Bonnie. All right. So now on that last point about political control of gold, I want to address a particular potential objection to owning gold, namely the risk that gold could be confiscated or outlawed by government. After all, this happened in 1933 in the USA, so in other countries, so why couldn't it happen again? I will not try to say that this cannot happen again. It could, but I want to tell you why I think it's unlikely to happen. So let's briefly go through the history of gold confiscation and then its re-legalization in the USA. In 1933, FDR, Franklin Delano Roosevelt, by executive order, made citizens surrender their gold, except for very small amounts, for $20.67 per ounce. In 1934, Congress passed the Gold Reserve Act, requiring the Fed to give all its gold to the Treasury. They fixed the value of gold held by foreign banks at $35 per ounce, but U.S. private citizens couldn't own it legally. And of course, they'd already given up their gold at $20 an ounce. What a great deal, huh? In 1971, Nixon, by executive order, said the U.S. would no longer convert foreign dollars into gold. And that was the final severance of the gold standard. In 1974, only 3 years later, Congress restored American citizens' right to own gold, and Gerald Ford rescinded the 1933 executive order. In 1977, Congress removed the president's authority to regulate gold under any circumstance except in time of war. And in 1985, the Gold Bullion Act allowed the U.S. Mint to make and sell gold coins to the public. So there is a history and a strong legal precedent for, restoring gold ownership. And it would take a very oppressive government to take that away. And it would be an admission of complete fiat money failure and it would be very, very unpopular or worse. And by law, it would be very hard to enforce. And by law, it would have to be in a time of declared war. So there is, a lot of time, precedent, public opinion, and law standing in the way of the government just confiscating your gold. Okay, in addition, since then, in addition to all this, most of the states, the individual states, have been gradually adopting laws encouraging the ownership of gold. For example, 43 states have removed all sales taxes on gold coins and bullion. And some states like Utah have said that gold certificates, like this Utah gold back pictured on the left of this slide here, which is very much like the bill I held up at the beginning, are considered legal tender under state law. Just a few days ago, the Wyoming state legislature, my home state, considered a bill that would have required the state treasurer to own and invest gold. That measure was unfortunately defeated by a 55 to 45% margin, but I suspect the issue will come up again, and I think it's remarkable that it was even considered. The point is that there's political momentum to recognize gold in commerce, and this momentum is percolating up from the grassroots at the state level. Okay, so Christopher says, I love gold, the taste and the smell of it. Well, actually, that is a good point, briefly, because I think it's true that gold, one of the reasons gold has attraction for ornamentation is that it is so beautiful. Excuse me, I have a little bump in the house here. Okay, if you're still with me up to this point, maybe you'd like to know how to channel some of your savings into gold. There are many ways to do it, and let me now do a quick flyover of some of the main options. First, there's just jewelry. If you're married or engaged, it's likely you already have a small investment in gold on your ring finger. Then there's gold watches and other jewelry that tend to appreciate in their market value. I know people, my wife included, who loves to shop estate sales for objects like these. Then there's bullion, or just the refined metal. Usually it's in the form of gold bars certified by a mint or a reputable refinery as 99.9% pure. Bars come in various sizes and weights, from less than an ounce up to a kilogram. Now there are basic coins, newly minted or circulated, that trade in their, at their bullion price at a plus a little premium depending on their condition. The buffalo coin I showed you was, an example of that. Here it is. Then there are the true collector coins, including ancient coins and relics, which get much or most of their value from, antiquity, rarity. There's a big warning here. Saving collectibles or buying, collectible coins, it requires much more than just knowledge of gold. But some people really love, the numismatics science and so forth. But it can be a great hobby, or if you want to get into it. Personally, I mostly invest in the coins trading closest to their bullion value because I do not wish to become an expert in collectibles. Just don't wander into, what someone tells you is a rare coin and pay too big a premium over the gold content. Now those are the main physical forms of owning gold, and I think everyone should own some physical gold. If you buy physical, you can store modest amounts of home in a safe place. If your holding has become significant, invest in a good safe and conceal it. You can also use a safety deposit box. No one outside a trusted partner needs to know that you own gold. No one needs to know. Now, if you own gold in real size, consider a bonded depository for some of it. These kind of facilities are insured and they're very safe, but they will charge you about 0.5% of the value of the gold per year for storage and insurance. I'll just mention that at Monetary Metals, we store clients' gold for free because both our clients and we, the company, earn interest on the gold, and this interest pays for storage and insurance. You can also invest in gold in paper form. That is, you can buy listed securities. So, for example, you can buy an ETF, an exchange traded fund that represents a specific amount of gold per share. The symbol GLD is the best known. This is a convenient way to accumulate gold that I have used in the past. For example, you buy the ETF when you have the money available, locking in the price of gold at that time. Then at your convenience, you call up the gold dealer and tell them the quantity of gold you want, and you to pay for it. All you do is sell your ETF, which exactly tracks the price of gold. So once you buy the ETF, you have no more price risk when it's time to buy the physical gold. So it's convenient that way. You can buy gold mining stocks as well. If you do, exercise caution and do a lot of research. Many gold mining companies are not well run. It's a very tough business. To reduce risk in a single company, you can consider buying any of the many funds that invest in gold mining, both ETFs and mutual funds. If you buy individual stocks, at least get a second opinion by a reputable advisor. I like some guys who are not expensive. Fred Hickey, Bill Fleckenstein, both are easily found online. Both have a lot of experience in this space. Both I have found to be very honest over the years. You can also get some basic advice from some of the writers on Seeking Alpha, but read and evaluate them carefully. If you get into gold investing at this level, you're going to eventually find your own trusted expert. If you're new to gold investing, start with the physical, get gradually into the paper. Now, there's one more interesting way to invest in gold that I want to mention, and that is through a royalty company. There are a number of these trading on the stock exchanges. Now, this particular, I took this screenshot from Seeking Alpha, and you can find it too. This particular writer catalogs and follows virtually all the royalty companies. Doesn't give much of an opinion on them, but just tracks their performance, let's say. Now, here's how these companies work. Royalty companies act as financiers to the mining industry. For a fixed upfront price, they buy a percentage of the mineral output of a specific mine or group of mines, like forever. In other words, the percentage is typically in perpetuity or for a very, very long period of time. Now, as the mineral is mined, the royalty investor gets paid right off the top before any mining expenses, and then the royalty company passes those returns right on to shareholders who own the royalty trust. And as the price of the mineral, either gold or silver or whatever, rises, the royalties go up. Most royalty agreements cover all the minerals from the ground, from that particular ground. So you get an option on further value down the road if other discoveries are made. There's virtually no expenses in running this kind of business. You just collect no operating expenses, let us say. It's all financing expenses. You just collect the sale value of the mineral, so it's a pure play on the mineral price. And I think it's an excellent way, it's a low-stress way to invest for the very long term. Now, you need to be careful about the share price at which you buy these things. Sometimes they get a bit out of hand, so you have to watch them and study them and look for a good entry point. But as the share prices, the share prices for these companies typically often applies a big premium to the current metal price. So beware, but over a long time, it works out pretty well. So just in pattern, I own a few of these. They've been very good to me. So just in pattern, here's what you might do if you want to start saving in gold. your mileage may vary. So this is just in pattern. First, set aside a bit of your monthly savings until you have enough to buy a little gold. To begin with, stick with items that are close to bullion value, like bullion or common coins. For example, for less than $4,000 today, you can buy four 1/2 ounce coins from a reputable dealer, or say 2 1-ounce coins. And as you accumulate savings, keep adding on a regular basis to your gold holdings. This should be a part of your should be a part of your real savings program, not just a little piggy bank you can break when you ever get an itch to take a vacation or go to Las Vegas. As your savings grow, you can consider alternative ways to invest and alternative storage methods, which I have described. There's a lot of information readily online about vendors, storage fees, funds, ETFs, and so on. And their commissions and their markups vary. So do your homework. How much of your savings should be in gold? Well, definitely not all of your savings. So I say start with 10%, then add as and when and if you feel more comfortable. Okay. Personally, I own physical gold in several forms, much of it in a secure bonded depository. I also own paper gold in the form of ETFs, royalty companies, gold mining stocks. That's just me. My program is not your program. There are many roads to successful investing in gold and otherwise. Okay. All right. So I'm running right up against time, but if it's okay, Daniel, I'm going to take 5 more minutes and close with some comments that I really love. Do I have 5 minutes? Hello, Daniel. All right. Well, I'm just going to take 5 minutes. How about that?
Yeah, sure, Jim.
Okay, sorry. That's sorry. So I want to quote extensively, and this is what's coming is probably my best answer to a question asked by Tom, who said he might be uncomfortable with the risks of owning and storing a high value item like gold. And it's true, yes, you do have to deal with the inconvenience of secure storage, but there are risks to owning anything that's valuable. And so a good question to ask in addition to your question, Tom, is what about the risks you do not take by owning gold, risks that are present in just about every other kind of investment? And this point harkens back to the scarcity, permanence, and independence of gold. So I'm going to quote from this person, Michael Weeks of Edelweiss Holdings. The reason we own gold as a reserve asset is rooted in something fundamental. What makes gold compelling are the risks we don't own by owning it. No forecasting or guesswork is required. The risks we don't take owning gold could fill volumes. With gold, there is no duration risk, credit risk, or liquidity risk. The metal is not moved by financial instability, nor threatened by national insolvency or chaos in foreign exchange markets. There are no margin calls and no refinancing risk. There is no risk of technological obsolescence, depletion, depreciation, or decay, nor does it require cheap energy, cheap credit, or cheap trade to remain viable. Gold doesn't care about your national energy policy or who you buy your gas from or how many pipelines are running. You don't have to keep the lights on or even keep it warm. There are no financial accounts to pour over, no balance sheet to blow up, no cash flows to dwindle, no stale inventory, and no margin pressures in difficult times. There are no key man or supplier risks, no competitive risks, no management to squander its future. It does not depend on the character, skill, or enthusiasm of anyone. It doesn't require the faith or goodwill of others. It doesn't require you to trust anyone at all. The absence of unwanted risks is the center of the absence of unwanted risks is the center of our investment approach. The principle applies to our choice of gold reserves as well as the business participations that we hold. Both parts are brought together by seeking to avoid the risks that aren't worth taking, and by extension, having the freedom to choose the risks worth embracing. We play the long game, but we are keenly interested in the kind of opportunity that makes sense through our own prism of what is valuable and worth possessing. Now, I could not have said it better. And finally, from this, another well-known gold investor. In helping people think about an investment decision, there are three choices: buy it, sell it, and the third, which is so often overlooked, do nothing. If you own gold as a liquidity reserve or a store of value, you have the luxury of being able to do nothing in periods of great upheaval. That's James Aitken. So I say in closing, at a minimum, buy some physical gold, then do nothing with it. Remember where it is, but forget you have it. Live without it. Most people will not do this, but I believe many will someday wish they had. That's one of my favorite slides, Gold is Physical Bitcoin by Russell Napier. And finally, if you have not already, you can subscribe to my Substack, which includes both essays and podcasts. And I wrote what I believe is a slightly entertaining piece on February 9th, in which I take to task ChatGPT as a very ignorant investment advisor. All right, let me see what else I have. Jerry says, Jim, are you going to address silver investment in your future episodes? I think I might do it peripherally. I can certainly give you some good references to compare it to gold. Just briefly, silver has kind of always been known as the working man's gold. You know, it takes up much more volume for its value, but and it's also not quite the ideal money that gold is. On the other hand, when gold moves big, silver often follows. So I'm certainly not against silver. It can be if it's kind of if you want to watch it kind of be your specialty, it can be great. I'll think about that, Jerry. I'll think about that. Okay. Well, Robert makes some really good comments there. Robert Nasir, he says, this presentation presumably goes along with my favorite financial advice: earn your money before you spend it. So true, so true. All right, with that, let us call it a day. I ran a little bit over time, 6 minutes. Thank you for staying with me, and thank you for subscribing. I will see you in a few weeks. I think I'll probably do an inflation update at that time, where I'm going to dive into inflation as it's currently understood and inflation as I think it should be understood. All right. Thanks, everybody. Take care. And see you next time.